Hey everyone, and welcome back to the channel. Today, we're diving into a topic that might sound complex, but is actually a cornerstone of smart, long-term investing: global diversification. If you've ever wondered if you should put all your investment eggs in one basket, or in this case, one country, then this video is for you. So, what exactly is global diversification? Simply put, it's the strategy of spreading your investments across different countries and regions around the world. Instead of only buying stocks or bonds from your home country, you also invest in companies and markets in North America, Europe, Asia, and other emerging economies. Think of it like building a sports team. You wouldn't want a team full of only star quarterbacks, right? You need defenders, forwards, and specialists to create a balanced, resilient team that can win in any situation. Investing is no different. Now, you might be thinking, but my country's economy is strong. Why should I look elsewhere? That's a great question. And the answer lies in managing something called country-specific risk. No matter how stable a country's economy seems, it's always exposed to unique risks. These could be political instability, changes in government regulations, natural disasters, or a sudden economic downturn that affects that specific nation more than others. We've all seen headlines where one country's stock market takes a nosedive while others are thriving. If all your money is tied up in that one market, your entire portfolio takes the hit. Let's look at a classic example: Japan in the late 1980s. The Japanese stock market was on an incredible bull run, and it felt like the party would never end. Many Japanese investors were heavily concentrated in their own domestic market. Then, the bubble burst in the early 90s, leading to what's now called the lost decade. The Nikkei 225 index, Japan's main stock market index, plummeted and took decades to even begin to recover. Investors who had only invested in Japan saw their wealth evaporate. However, during that same period, other markets, like the US, were performing quite well. An investor who had diversified globally would have had their losses in Japan offset by gains elsewhere. Their portfolio would have been much more stable. This isn't just an old story. It happens all the time. Think about the UK with Brexit, trade tensions between the US and China, or economic challenges in various European nations. These events create volatility that is often localized. By diversifying, you're not putting all your faith in one country's political and economic climate. You're building a financial shock absorber. When one market is down, another might be up, smoothing out your overall returns and reducing the anxiety that comes with wild market swings. But diversification isn't just about playing defense and avoiding risk. It's also about capturing opportunities for growth wherever they may appear. The world is a big place, and economic growth doesn't happen evenly. For decades, the United States has been a powerhouse, but today, some of the fastest-growing economies are in Southeast Asia, Latin America, and Africa. These are what we call emerging markets. They offer incredible growth potential as their middle classes expand, technology advances, and their companies become global players. By limiting yourself to your home country, you could be missing out on the next big global success story. Think about companies that have become household names worldwide. Many of them aren't from your home country. Investing internationally gives you a ticket to participate in their success. You get access to different industries that might be underrepresented in your domestic market. For example, one country might be a leader in technology, another in renewable energy, and a third in luxury goods. A global portfolio lets you tap into all of these powerful trends. Okay, you might say, this sounds great, but isn't it incredibly complicated and expensive to invest all over the world? 20 years ago, you'd have been right. It used to be the domain of only the wealthiest investors and large institutions. But today, thanks to financial innovation, it's easier and more accessible than ever before for the average person. The magic words here are ETFs and mutual funds. ETFs, or exchange-traded funds, are one of the simplest ways to achieve global diversification. You can buy a single world stock market ETF that holds thousands of stocks from dozens of countries, all packaged into one simple investment. For example, a fund tracking the MSCI World Index gives you exposure to large and mid-sized companies across 23 developed countries. With one click, you're diversified across the globe. There are also ETFs that focus specifically on emerging markets or specific regions like Europe or Asia. You can build a globally diversified portfolio with just a few of these funds. They are low-cost, transparent, and trade just like a regular stock. Mutual funds offer a similar benefit. Many global or international mutual funds are managed by professionals who do the hard work of picking stocks from different countries for you. You invest your money in the fund, and the fund manager handles the rest. This can be a great option if you prefer a more hands-off approach. The key is to look for funds with low expense ratios, as high fees can eat into your returns over time. So, how much should you allocate internationally? There's no single magic number, as it depends on your age, risk tolerance, and financial goals. However, many financial advisors suggest that international stocks could make up anywhere from 20% to 40% of your total stock portfolio. Some even argue for a market cap-weighted approach, where you allocate your money based on the size of each country's stock market relative to the world. Given that the U.S. currently makes up a little over half of the global stock market value, this approach would mean investing nearly half your money abroad. The most important thing is to start. You don't have to do it all at once. You can gradually build your international exposure over time. The key is to have a plan and stick with it. Don't try to time the markets by guessing which country will do best next year. The whole point of diversification is to admit that we can't predict the future. Instead, we build a robust portfolio that is prepared for a wide range of outcomes. To sum it all up, global diversification is a powerful strategy for any serious long-term investor. It helps you reduce risk by not being overly dependent on the fate of a single country. It opens the door to growth opportunities in fast-growing economies around the world. And thanks to modern investment products like ETFs and mutual funds, it's easier and more affordable to implement than ever before. Don't let geographic borders limit your investment potential. By thinking globally, you can build a stronger, more resilient portfolio that is better positioned to help you achieve your financial dreams, no matter what happens in one corner of the world. Thank you so much for watching. I hope this breakdown was helpful. If you got any value from this video, please hit that like button and consider subscribing for more content on smart investing. Let me know in the comments below what percentage of your portfolio invested internationally. I'd love to hear from you. Until next time, invest wisely and take care.